Hello and welcome to the Market Musings podcast, where today we welcome Adam Davidson, the CEO of Trident Royalties, listed on the AIM market. Hello, Adam, and welcome.
Yep. Hi, guys. How are you doing?
Good, thank you. How are you?
Very good.
And Kenny's with us as well?
Yep, up here in Scotland. Yep. Weather's okay, makes a change. We always do a bit of a weather forecast in Scotland, so we do, Adam, when we're on the podcast, because it's usually raining, but for today it's reasonably bright. But no, it's great to have you on the podcast. And what we like to do in the podcast first is we like to get a bit about your background. You know, what you've done in the past, who you've worked for, you know, what your education was, you know, any career changes or just anything that's interesting that we think, you know, investors would like to hear about. So really, it's an open floor for you, Adam, just to tell us a bit about yourself, and you can go back as far as you want. You can go back to your childhood, where you were born or grew up. It's really up to you.
Yeah, sure. Yeah, so I suppose real quick on my background, I joined Trident just at the tail end of last year, and I'll give you a bit of history on Trident sort of separately, but yeah, I joined at the same time as a colleague of mine down in Perth, Australia, and I'm based here in Denver in the US. Prior to that, both of us were with a group called Resource Capital Funds, which is a mining-focused private equity fund. So I started with RCF in the Denver office, spent a few years there, went down to the Perth office for a couple of years, and came back sort of, I guess, the middle of last year, and then formally made the jump into Trident at the tail end of the year. And at RCF, my background was, I was on one of the investment teams. So, was involved in leading investments, pretty much every continent, obviously, except Antarctica. So did deals in Australia, Asia, Africa, and North and South America, and even one small transaction in Europe, despite not having a huge mining industry. And across the sort of commodity spectrum, the sort of the vanilla stuff like copper, gold, to more opaque commodities like mineral sands or bauxite. A good breadth of experience investing in the mining space with RCF. And prior to that, I was with BMO Capital Markets, the big Canadian bank. I was in their metals and mining equity research group, again based here in Denver, specifically covering coal and steel. And then prior to that was in strategic planning with an ASX listed company called Orica Mining Services. Their North American headquarters is here in Denver, and we covered sort of Canada, US, and Mexico. But effectively, they provide a lot of the blasting and services to the mines. So, a lot of time on the ground at the mines in those jurisdictions, and planning and forecasting and sort of strategizing around Orica's business in this part of the world. That's my sort of quick, 10-year background in a nutshell. In terms of education, studied math in undergrad, and then did an MBA with the finance and accounting concentration, and then did a postgraduate in mining from the University of Arizona. I know enough on the technical front to be dangerous. And then, obviously been in mining finance now for the bulk of my career. And probably worth flagging my colleague down in Perth, because it's really the two of us that are sort of the lead with regards to the management team. So his name's Tyrone Reese. He was also with RCF for about 6 years. And he's got a technical background. So he's a metallurgist by trade. When Sandfire discovered the DeGrussa project, he was involved in the commissioning there, and then moved to Newmont Gold Corp and was involved in commissioning one of the mills at Boddington before doing his Masters of Finance and CFA and all that, and was with RCF then for about 6 years. So it's really the two of us, myself on this side of the world and him down in Australia, that are sort of leading the day-to-day operations at Trident.
Okay, so so it's listed in London. You're in Denver, and your colleagues in Perth, Australia.
Yeah, that's right. Yeah, and I know where you're going with this question, because we've definitely gotten it before with regards to having a team sort of spread out. I suppose we saw the importance of being in the mining centers. So, Denver in this part of the world, I'm a quick flight to Vancouver and Toronto, and obviously there's a big mining industry here in Denver. And and Perth is sort of the mining epicenter of the world. So with those two locations, and then our board all sitting in the UK, we felt like we were covering off the right jurisdictions. So really, it's then, can the business model, can you juggle the separation? And in normal times, we'd like to get together more frequently than we have, obviously, in the current environment. But I think if you look at some of the peers, take Metalla, for example, circa 200 mil market cap, and their CEOs in California. I think the CFO is in Florida, if I'm not mistaken, listed on the TSX. So it is a model that, we're not operating mines, and we don't have hundreds of employees. In fact, Royal Gold here in town, at 8 billion market cap, gold royalty company predominantly, but they've got 20 odd people in the office, because effectively you're buying financial instruments and sort of putting them in your wallet, so to speak, and auditing them and monitoring them. But really, from there, it's a sort of rinse and repeat. You acquire more royalties, you build more size and scale. So you can do this in a more sort of nimble fashion, I suppose.
Now, we had our first guest from a royalty company, and he was explaining to us that really the royalty model is more of like a North American style. And is that correct? And I just wonder why, is there any reason why you've got the London listing?
Yeah, a couple of reasons, actually. And I won't go sort of name by name of all the peers, but there's a chart on our corporate presentation, I think, that lays it out pretty nicely. But effectively, if you rewind the clock 15, maybe even just 10 years, I think you'd have sort of 2 to 3 players in the mining royalty space. And the genesis was precious metals out of North America predominantly. And so even though when you look at the space, there are some, as I mentioned, multi-billion market cap. You've got Franco, it's sort of around 25 billion, and Wheaton, it's sort of closing in on 20 billion, and Royal Gold around 8 billion. So, there's some very big, large companies. That said, the business structure in itself is still sort of, I guess, not in its infancy, but maybe in its adolescence, in the sense that we do still see opportunities in the space. And there are a flood of new royalty companies going on to the TSX with the precious metals focus. There have been sort of just 3 or 4, I think, so far this year. And the fact is there's only us and Anglo Pacific listed in London, and about 20 odd listed on the TSX, and none surprisingly in Australia, despite being a massive sort of mining jurisdiction. But I suppose the opportunity we see is yes, for precious metals royalties in North America, it's a very competitive space, both with regards to getting capital for the royalty company as well as deploying it and acquiring royalties. Much less so when you get outside of precious metals, and specifically for precious metals when you get below a certain ticket size, because obviously the big boys don't want to do a $5 million gold deal. They're looking for an $80 million deal. So we saw a few opportunities in the space, but I guess back to your original question of why London, I suppose fundamentally we don't see any reason why this model has been so well served to Canadian investors, and that it can't function the same way in the UK. Yes, there's going to be a bit of an education process, and things like this podcast are part of that. But ultimately, it's going to be driven by cash flows. And as we close in on announcing a dividend policy and then subsequently announcing a dividend, that's where investors can quite clearly see, the kind of cash flow that's going to flow through the vehicle, and then it'll become a self-perpetuating thing, and that people will buy in because they want exposure to that cash flow.
Yeah. So just for sort of helicopter view, Adam, what are the main benefits of sort of royalties and streams, the model? What's different from a normal, most investors just invest straight into, a junior explorer or maybe even a producer or whatever. So, what's the main differences in the benefits?
Yeah, there are a couple of things that really stand out with sort of the why royalties and streams question. I mean, the first thing is you get exposure to the top line of the P&L, whereas equity obviously is at the bottom line. And so what that really means is when the underlying commodity price ticks up, that increases the company's revenues, and your royalties effectively, there's a million ways to slice and dice it, but effectively it's just you're getting paid a portion of their revenue. I think what many investors, as you said, if they've invested in sort of mid-tiers or juniors, if you invest in a major and you want your commodity exposure in that way, you're obviously not going to outperform, but you'll get the exposure, of that major, whether it's BHP or Rio. if you start to delve into the mid-tier and junior world, you're getting that exposure, but it gets a bit more convoluted, and you start to have to feel very comfortable that you can pick the winners in that space. So I suppose royalties really split the difference in a good way. That's really appealed to investors, in that you get exposure to the underlying commodity, which is driving a lot of what investors want. In a market like this in particular, if you want exposure to real assets, you see fiat currency being printed as quickly as it can be, and you want exposure to real assets, and mining commodities are a part of that. There's only a few ways that you can get that exposure, and royalties give you that top line exposure, because I think many people have invested in miners, watch the underlying commodity price tick up, but the miner goes out there and spends a fortune on drilling or expanding their plant, or does ill-advised M&A, and a royalty holder, you don't have to worry about that, because you're getting the top line exposure. In fact, some of those things can be very accretive to the royalty, because if they go out there and drill and build up their resource, that just extends the life of the mine, and that benefits the royalty. But they're using equities money to do that. Similar, if they expand the plant, revenues expand as well in time, and the royalty benefits from that. But it's not the capital that's paying for it. So you get all that sort of upside of the actual asset. So in that sense, it's better than just parking it in a commodity index fund or something like that, because you're still getting that asset level exposure. But you're mitigating a lot of the risk in the sense that you're getting the top line exposure, and then couple that with the fact that royalty company, we're not operating a single mine or two mines. We're getting currently Trident's getting royalty revenues from two operations, and we're only 2 months into building our business. But over time, you'll build it up to where you have the choice, and if you just use a high-level example, you can buy a miner that's producing 100,000 ounces from a couple lines, or you can buy a royalty company that gets an equivalent 100,000 ounces of production, but from 12 royalties in 8 countries. And obviously, that's a completely different risk profile. So those are some of the things that really make royalty sort of a standout for investors. And that's why they tend to trade at higher multiples than the miners themselves.
Okay. And just looking at the sort of business model, Adam, you've got quite a nice. Well, you've only got 3 projects at the moment, but it's obviously you've got base, precious, and sort of battery metals in the mix as well. What is your sort of target commodity?
Yeah, and that really is the crux of the strategy. Is when you look at the peers, they're all predominantly precious focused, and then there are a couple that are sort of more project generators, so they're pegging ground and then trying to spin it out for a royalty, so a bit more like an exploration company. And then obviously AngloPac is very heavy sort of coal exposure, and fundamentally at a different stage in its life cycle where it's paying a healthy dividend and looking to maintain that. And what we really want to do is build a portfolio that over time is representative of the mining sector by commodity, because there's nobody out there that's doing that at the moment. So, and when I say representative, I mean roughly a third precious metals, a third base metals, and a third bulks and battery metals and industrials and sort of everything else. Because I think what you can do is extol the virtues of royalties like I've just done, and investors get it, and it's a pretty proven business model, particularly on the precious side. But then the next natural question is, I like that. I want to get, put X% of my portfolio into mining commodities, and you've sold me on the royalty approach. So now where do I get that exposure? And that's where you're sort of left scratching your head. And really that was the impetus for Ty and I to make the move out of RCF. Was RCF, had done royalty deals. You make an equity or mezz debt investment, sort of tack on a royalty. And the precious ones are pretty easy to monetize. There's enough buyers out there willing to pay full value for them. But then you're sort of left scratching your head with, what do we do with these non-precious royalties? There's just not a natural home for them. Despite the fundamental fact that $1 from a copper royalty is the same as $1 from a precious royalty. It just struck us that there's a big gap in the market. So for us to, we'll target the most accretive deals, out of the gate. But ultimately the aim is to provide investors with sort of they can hold a single share of Trident and get broad sweeping exposure to the full suite of mining commodities from a royalty perspective from that single share.
And it's a young company then?
Yeah, no, very young. So we listed on the AIM in June 2nd, so just not even 2 months old.
Right.
And we did so in conjunction with a £16 million fundraise. And we had a little over 4 million US sort of in the bank from the original Trident shell. So yeah, we started out with a fair amount of capital, which is important in this business because it is about building critical mass and diversification in the portfolio. Yeah, so we conducted that raise, and since then we closed on 3 royalties and are charging ahead on a couple others. So hope to continue to flesh out the portfolio through the end of this year.
And these opportunities, Adam, how do you identify them? Do they come to you? Do you go to them? What is the? I suppose it's a bit of both potentially.
Yeah, it's a bit of both. So the original Trident shell was set up by 3 advisory groups: Tamasis Partners out of the UK, and then Azure Capital and Ashanti Capital, both out of Australia. And being predominantly resource focused, or in the case of Tamasis, specifically mining focused, you do get a lot of opportunities that come via the advisors, and then obviously board and management. We have our own networks. So looking back at the 3 deals we've done, I think we have had examples of one that was sourced from the board, one that was sourced from management, and one that was sourced from the advisors. So I think, no shortage of deal flow in that regard. And then we also do sort of the bottoms up analysis of, what commodity or what jurisdiction, what stage asset do we really want to get exposure to? And then, looking at the full spectrum of opportunities in that space, and then, sort of targeting a short list of who do we approach. But to be perfectly honest, we're getting enough inflow with regards to pipeline opportunities that we haven't had to go out there and source too aggressively because we're getting enough coming in sort of just organically.
Yeah, but it certainly sounds like a good model. And obviously, if you've got your wee black book of contacts, it always helps in these situations. Do you have like a sort of target number for your pipeline? I mean, you've got 3 at the moment. Have you got like a year ahead? You're targeting another 6, or?
Yeah, it's a little bit difficult. I mean, really the priority is building up that future cash flow profile. So I mean, obviously you'd like to diversify that as much as you can, but if you do a big slug in one particularly attractive asset, we're not averse to that either. In our most recent quarterly update, we flagged that we've got 15 active NDAs.
Yep.
Yeah. So I mean, we are very, very active with regards to looking at opportunities, and I suppose that's one area that we recognize we need to be a little bit different from all of our TSX listed peers, is because the model is recognized there, that they can get a gold royalty and kind of sit on it, and the market will give them value for that and will recognize it. We're probably less prone to get that on the London market. I think we recognize that building up tangible cash flow is really what's going to resonate with investors. And that's quite understandable, because I think there are quite a few examples of the TSX royalty codes that have picked up a few royalties and then kind of just sat there or floundered for a bit. And that's obviously not the direction we want to go. So I think we're off to a good start. When you look at the first 2 cash generative royalties we've acquired, and we can talk to the specifics of them later, but we're already, having deployed that capital, we've already got a pretty healthy cash profile looking at 2021 and beyond.
Yeah, as you say, we'll come to them later. I'm interested as well, Adam. So at the moment, you've got 3 projects, 2 producing, 1 non-producing. Do you have a split that you're going to try and maintain in the future, or is it just based on a project by project case?
No, it's we don't have a sort of firm split with regards to percentage or anything like that, but we are highly prioritizing cash flowing assets or near-term cash flowing. I think this is one area where actually being diversified is a real benefit, is that when gold is closing in on $2,000 an ounce, we're not a gold only company that has to go. Well, they sort of have the option of either sit on their hands until things get look a bit more sensible, or continue to write deals. So they kind of got their backs against the wall in that sense. Whereas we can look at other commodities that perhaps have sort of more accretive fundamentals. So you'll notice our first couple royalties were paying royalties were in copper and iron ore, which are both performing really well. But yeah, you sort of are less beholden to the price and the way the precious guys are. And then our third royalty was a precious metal royalty, but it's development stage, and you can get a much more sensible valuation relative to paying for a currently operating paying gold royalty. So yeah, long-winded way of saying we're prioritizing cash flow, but we recognize part of why royalty companies get valued the way they do is because you get an early stage exploration royalty, and in 4 or 5 years' time, that can turn into something really exciting, and you've bought it for next to nothing. So getting some of those into the mix is also priority. But the bulk of our cash on the balance sheet will be deployed on cash flowing or near cash flowing royalties.
Well, it's good that you mentioned that about excitement, because I was going to ask about that, Adam, because this whole royalty model, certainly for me and maybe for investors in the UK, is a relatively novel idea, I think. I don't know about you, Kenny, but it's not something that I'm very familiar with. And the name royalty, it sounds very grand and sort of prestigious. Is there excitement involved then? Can investors get excitement from a royalty company, or is it more geared towards an investor who wants exposure to mining but perhaps doesn't want the inherent risk that comes with exploration?
Yeah, and it's to be honest, it's a little bit of both. I mean, it's got this risk mitigation element of getting cash flow from multiple assets and sitting at the top line, so an OpEx blowout doesn't, or the need for sustaining capital to be spent on a specific operation, that doesn't eat into the royalties profitability. So it's got those risk mitigation elements, but really where the excitement comes in for investors is when you buy a royalty over something that's modeled as having an 8-year mine life, and then we know how these things go. Once the capital's been sunk, they'll turn around, they'll start drilling, they'll try to expand the mine life as much as possible. So it's very, very common to see a mine that starts out with a certain life, double that or even triple that. And as a royalty holder, and I should say that they're doubling and tripling it by using equities money to drill and find more resources and do the development and the CapEx that it requires. So that's why people like royalties. And that's where the sizzle does come in into the story is, you get a royalty over an asset. Take our gold development one, for example. It's got a JORC compliant resource of about 355,000 ounces. And JORC is sort of the compliance code in Australia for resource and reserve reporting. But then it's also got a JORC compliant exploration target, which is just a more rigorous sort of framework for how you actually quantify exploration upside. But that sees it potentially exceed 1 million ounces. And so the royalty on a standalone basis on those 355,000 ounces, assuming the mine is built within a couple of years, is very accretive, sort of plus 40% IRR post-tax for us. But then where the really, really exciting part comes in is if they do, and they sure, they absolutely will, if they build the mine, they'll start drilling for more resource. And that's where, if they can double the resource or triple it, that suddenly it becomes kind of a home run of a deal. And there's numerous examples of that where, a royalty gets written for, $500,000 and 30 years later, it's still paying, $10 million a year, because the mines continue to operate. So yeah, that's that sort of exciting bit. And that's why it is important to have a bit of that into the portfolio. We recognize the need for immediate cash flow, but you don't get those as cheaply as you do sort of development and exploration stage stuff. So when we look at development and exploration, the one overriding key criteria is that there has to be a credible path towards production, because there's no shortage of sort of exploration ideas. And if we wanted to, we could go out there and pick up a couple hundred royalties on projects that are going nowhere. But what we want to do is get stuff that we see as credibly being in production within sort of 4 or 5 years.
Okay. And if you going with that model, is it fair to say then that a royalty company adopting a similar model to yours is maybe less likely to suffer from issue of equity and dilution?
Yeah, I mean, and that's part of the balance we have to strike, I suppose. Being listed on the AIM is we watch some peers going out there and sort of picking up development stage assets, and they can do so. And then when they need to raise money for G&A, they can go out and tap into the markets and there's that sort of acceptance of the model on the TSX. But we're conscious that we may not get the sort of the same benefits in the London market. So when we picked up our first royalty, which we did so with that sort of $4 million US that was in the original Trident shell, one of the key criteria for us was that we want this particular royalty to be paying, for one, to be over a good asset in a good jurisdiction, operated by a good operator, and to cover our G&A for the foreseeable future. And so again, we can talk to the specific assets later, but the royalty that we acquired more than covers our G&A. Just the Q2 payment was just over 900,000 Aussie, just for the one quarter. And our G&A is $1 million US per year prior to deal costs. So, we think when we picked up that asset that it sees us comfortably covering our G&A. So when we go back to the markets, it's because we've deployed this capital. Hopefully people have seen the share price, re-rate because of that deployment, and then we're raising it at a higher price in the future.
Okay.
Yeah, that royalty you were referring to, Adam, was the iron ore royalty in Australia.
Yes, that's right.
Yeah, iron ore. A lot of people think, oh, it's boring. It's it's a bulk mineral, or whatever you want to call it, but it's absolutely flying out of Western Australia. The amount of stuff they're shipping out, you'll know yourself. It's probably the best place in the world to get iron ore because of the high grade. It's DSO. It's just shipped direct. So when I seen that in your presentation, it kind of ticked the box for me. And it's interesting. I've never seen a royalty on an iron ore project before. But then I don't really know much about royalty companies, but it looks really interesting. They've got quite a big resource there, and obviously potential to expand the resource as well. Can you give us a wee overview of that particular royalty?
Yeah, sure. Yeah, no. So it was the first one that we acquired. We announced it in March, but we didn't close till June 3rd. CP to close was our IPO on AIM. So once that was completed, we closed on it. That said, the royalty started accruing to us as of January 1st of this year. So that Q1 payment sort of went off the top of the purchase price. But yeah, effectively, it's an iron ore operation in Western Australia. And you're right, the economy of Western Australia does hinge on iron ore. It's a 1.5% FOB, so it is a very simple operation. They dig it up, crush it and load it onto the trains and load it onto the ship, and it goes straight to China. So it's established operation. The royalty is over one pit of a 4-pit operation. It happens to be over the highest grade pit. It's operated by ASX listed major mineral resources, and they've got a really strong balance sheet, which is obviously important to us because although royalties aren't exposed to operating and capex sort of costs, they are in the sense that it becomes binary. If the operation shuts down, your royalty no longer pays. So you want to make sure you have a good, well-capitalized operator. And they've got about $1 billion on their balance sheet from a recent asset sale, and have allocated 120 million Aussie to expanding Cooley&Abing, which is the operation we have the royalty over. So they ramped it up last year from annual throughput of 6.5 million tons up to 11. This year they're ramping it up from 11 to 15 million tons. Now that's from the 4 collective pits. And their recent quarterly announcement, they announced that they're up to a 12.5 million ton throughput rate on an annualized basis. So yeah, from our perspective in Australia, a paying royalty operated by a major who's investing in the asset, a simple operation that's proven, so you don't, because you're not processing the ore and have those sort of potential recovery issues. It is DSO, as you said, they dig it up and ship it. It's very, very simple, sort of straightforward operation, and we think we got it on very attractive terms and caught a bit of a windfall. We were bullish iron ore, but recognized that it's less well understood by the market, and don't know where it stands today. But at least prior to gold's sort of recent run up to sort of nearly 2,000 an ounce, iron ore was the best performing major mining commodity of the year. So it was trading up to it went over $110 per ton, and has sort of tapered down to sort of 106, I think, as of today. But numbers that we're very happy with. I think the consensus economics sort of forecasts had it drifting down into the low 70s at this point in time, and that's what we were modeling. So yeah, to catch that windfall early in the royalties life obviously is incredibly accretive to the IRR. And the terms of that acquisition, we paid $4 million upfront in Aussie dollars and $3 million in a year's time. As I said, the first quarterly payment, which was 540,000 Aussie, came off the top of that first tranche. And then, second quarterly payment was 903,000 Aussie. In the first quarter, they're doing quite a bit of pre-strip, which sets it up well for these next couple quarters. So, I mean, you can do sort of the back of the envelope math, and on a post-tax basis, that's sort of well above a 20% IRR. So yeah, for a first royalty and with limited capital to work with, we thought that this one was really attractive.
Yeah. And you said it's a royalty over one of the four pits, Adam.
That's right, correct.
Yeah. So is there an opportunity perhaps to get the other three pits, or do those royalties sit with other companies?
No, in fact, I don't know if the other pits have royalties on them, but don't believe they do. At least not royalties in private hands. So no, this royalty is over, and the way it works in Australia is it's over a particular land tenement, and it's tied to that tenement. So, if they were to ever sell it, for example, the royalty conveys with it and effectively never goes away. Which has some benefits, because there is another deposit on the southern part of that tenement. We don't attribute we don't attribute any value to it, but there has been work done on it in the past. The drill holes have been put in on a relatively tight grid. And then there's a historic resource on it. So, it's all sort of price dependent, but, again, that kind of circles back to that royalty upside. We're valuing the reserve that is to be mined. Obviously, when iron ore ticks up the way it has, some of the resource that we didn't place any value on could convert to reserve, because now they become economic. And then the blue sky is, there's this other deposit of iron ore on a separate part of the tenement that we didn't place any value on, that someday could have value. So, when I talk about sort of the returns on that specific royalty, that's based on the reserve and attributes very, very little value to the stated resource, and no value to that sort of historic potential resource.
Right. Just out of curiosity, Adam, so say for instance that you talked about that portion, the tenement in the south, if they started drilling that and they hit some gold along with iron ore, just for example, I'm just using that as another commodity, are you guys covered for the gold as well, or is it only the iron ore?
No, it's and this kind of varies by the royalty and the way it's drafted. Yeah, so this particular royalty is for iron ore. And then, in fact, our second royalty, the one over the copper mine, we can talk to later, but that one is specific for copper as well. But there are other royalties that are drafted to be over any mineral that's extracted from a particular tenement.
Yeah, because obviously you get some polymetallic deposits. I've got a whole suite of different commodities, so it would be quite difficult to nail one particular commodity down. But no, the iron ore looks really interesting, and the fact that I think you said in Q2 the royalty you received in Q2 almost covered a whole year's running costs for the company, which is quite astonishing when you think about it.
No, that's right. We're we were pretty pleased to get it, because I think it did tick all those boxes, and well and truly more than covers our G&A for the next sort of 4 or 5 years. So we were pleased to get it into the mix.
Perfect. All right, so we'll move on to the you've got another producing royalty. It's the copper asset. I think you pronounce it Mimbula. Is that correct?
Yeah, Mimbula. Yeah,
and that's in Zambia. Can you give us a wee heads up on that, if you don't mind, please?
Yeah, sure. So this is a good example of when a mining company would accept a royalty, because I sort of talk to the virtues from an investor perspective, and I'm sure people are wondering, well, why would a miner want a royalty over their property, particularly if it never goes away? And in this particular case, the company is ramping up production, so they shipped their first copper cathode last month. But at the end of May, got into a sort of a tight cash position. Sub $1 million. They weren't desperate by any means, but obviously wanted to shore up the balance sheet. And as a private company, they're looking to actually list in London next year. So, in the midst of a ramp up when they're sort of just at the cusp of revenue, didn't want to set sort of share price expectations and do a quick fundraise via equity. Similarly, debt would be just too slow of a process, but they wanted to get capital in. So a royalty sort of makes sense. And the way we structured it, I suppose, worked for them and us. It's a 1.25% gross revenue royalty. So, for every $100 of revenue, obviously we get $1.25 of that. But once we've recovered our $5 million investment, then it steps down to a 0.3 gross revenue royalty. And then once it's paid on 575,000 tons of copper, which is a fair amount of time in the future, then it steps down to a 0.2. So if we ever got to that stage, we'd be pretty pleased. But it is sitting over the property now in perpetuity. And the other thing, the other way that we structured it was because they are in ramp up and there's a fair amount of uncertainty with regards to production profiles. We put in a minimum payment schedule, so it does have almost a debt-like characteristic. This year, it just pays its percentage on their revenue. In 2021, it pays a minimum of pays the higher of $375 US a quarter, or what that royalty rate would be for the quarter. That steps up to $500,000 a quarter in 2022, and then for the first 2 quarters of 2023 is $750,000 per quarter, and that sees us effectively repaid our $5 million within 3 years. And obviously, if they hit their production numbers, it would be less than that. So from our perspective, gives us exposure to a large, it's nearly 100 million ton at 1% copper. That's a very large, meaningful copper asset. Yep. At the very beginning of its life, so it worked very well from our perspective and from their perspective. When it, when they pay down and it steps down to that 0.3 revenue royalty rate, that becomes a bit of a rounding error, meaningful for us, but a rounding error from the size operation that they're contemplating. So worked for them as well, and they're private, and so don't want to sort of speaking to their production profile, particularly as they're sort of pre-IPO. But they were comfortable for us to say that at the copper prices at the time when we struck the deal, which was sort of $5,900 a ton, it's now sort of $6,500 a ton. But at the copper prices at the time we struck the deal, that they obviously plan to exceed the production that implies based on the minimum payment schedule. So doing the math for you, that they're targeting sort of over 20,000 tons of copper production next year. That steps up to 27,000 tons the following year. And then by 2023, over 40,000 tons. So yeah, a very meaningful long life copper asset that we got a royalty over.
Yeah, it's about 20 years, isn't it? Probably. Just doing quick maths in my head while you were talking there. Just out of curiosity, Adam. So you said that this company were obviously they're pre-IPO and they had a rather than go through the long process of getting some debt or equity to get them over the line. How long does a sort of royalty negotiation take? I mean, is it quite a? Obviously you need a site visit, or you maybe need a competent person to go out and have a look at the asset. But what's the kind of timescales from sort of start to finish? I mean, I imagine every project's different, but just for a rough idea for investors.
Yeah, no, I mean, it does really depend on the asset and how well you know it in advance, and whether you've been there or you have trusted parties that have been to site and sort of the technical work that they've done. If they've got a feasibility study, then that can fast track a lot of work. If it's an earlier stage asset and you're sort of picking apart its resource and trying to understand the ore body, that obviously can take a bit more time. So yeah, I don't have a great answer for you. It can be sort of it can be very quick, and we sort of quite intentionally we're a small group. We want to be nimble, and opportunities like this, they would go away if we had said it's going to take us 3-4 months to get there. Then the opportunity disappears. So yeah, I mean, it can be as quick as measured in weeks, or they can there some transactions that we're still kicking along that we started looking at sort of earlier this year. So yeah, it really runs the gambit.
Yeah. Okay, right. So that was we've covered copper, iron ore, and obviously the one you announced recently. You purchased the royalty from Thor Mining, which myself and Mark know pretty well.
Mm. Yeah, no, that's right. This one's a royalty over a gold asset, and yeah, I touched on it a bit earlier when talking about sort of the exploration upside. 355,000 ounce deposit in a within trucking distance of a couple mills, but one in particular that they've done bulk samples through that's less than 30 k's away. Yeah, and I suppose important to flag, it's a very large land package. So with that JORC compliant exploration target of an additional up to at the moment 734,000 ounces, but we'd see whether it's that full amount or less than that or exceeding that. We see it as being a pretty meaningful gold development asset. that doesn't need to build a new plant, which makes it much more imminently doable with regards to, you just start mining it and toll treating it through that existing plant. So a very credible pathway towards production, and a company that currently owns the asset, that's advancing it and putting money into it, and all those sort of tick in the box type things that we need to see to get excited about a development asset. I suppose the only other thing to flag on this one is this structure is sort of how we're approaching some of these development assets, in the sense that we paid a small upfront portion of the consideration to acquire the royalty, but then the bulk of the consideration is production linked. So when it's paid on 25,000 ounces, they get a second tranche. When it's paid on when the royalty is paid on 50,000 ounces, they get a third tranche of the consideration. So, what this does for us is it sort of mitigates some of the development risk, because obviously once it's up and running, that means it's fully permitted and it's producing. So it allows you to get that development exposure into the portfolio, but you're doing it with a smaller sort of upfront cash ticket, and the bulk of the consideration comes once that development risk is mitigated, which is important for us, because then we can preserve our capital to get those sort of cash flowing royalties and build up the cash profile and start to inch towards that sort of that dividend policy, but still gets that excitement of exploration and development assets into the portfolio, just for sort of a smaller upfront consideration, and the bulk of it sort of contingent linked.
Yeah, and this is a slightly different structure. That's a variable price royalty, this deal.
Yeah, that's right. This one's not sort of a strict percentage royalty, so it is different in that sense. And that does kind of come down to, royalties are one particular asset class in the full suite of mine finance. So you think it'd be sort of narrow and straightforward, but the fact is you can, like you saw in the copper one, we put in this payment profile. I mean, you can sort of adjust them as needed to fit a particular asset. Now this was an existing royalty, so we didn't do the structuring here, but yeah, a good example of there are varying structures and how these things are written.
What did you like about the ones that you chose, Adam? Was there anything particular that you sort of go for?
Yeah, I mean, I suppose with the two cash flowing royalties, it's in two commodities that we like, so iron ore and copper. I think that's appealing. The iron ore one, as I said, operated by a major in Australia. The copper one, getting in that minimum payment schedule and having a pretty juicy return profile on one of what we think will be sort of one of the best performing commodities over the next sort of 4 or 5 years, and on a very long life asset. This one will be paying us for the foreseeable future. So I think both of them appeal to us for varying reasons, but we're the type of asset that we're really looking for, and collectively pretty meaningful revenue. We're looking at on the iron ore one, we'd be disappointed if it didn't pay 3 million Aussie this year. So that's circa 2 million US. And then obviously you can next year, and then on the copper royalty, you can obviously, the minimum payment schedule is a minimum of 1.5 million US next year. And obviously both us and the company hope that they exceed that. But just on those two numbers alone, that's 3.5 million US in cash flow, from having deployed, less than 9 million to acquire these two royalties. And as I said, the iron ore one is shorter life than the copper one, but still, pretty meaningful cash flow for the foreseeable future, and a good quick return on capital, particularly the way the Mimbula royalty is structured. And I think hopefully that's going to appeal to the London investors as we continue to build the portfolio and diversify our cash flow, to be able to deploy capital and see a quick return and long exposure to those commodities and those particular assets. I mean, that really, and ultimately, I mean, from an investor's perspective, when you build up enough, and we think, when I say enough, when you start to close in on sort of 10 million a year in revenue, that's when you start seriously thinking about, do we start letting this flow through to investors via dividend? And I think if Mimbula performs the way we hope it does, and if a couple of these other royalties that we're advancing on, we'd be hopeful to be closing in on that sort of in the near term. So that's, and so each of these individual royalties, with regards to why do you like them, it all builds to that story of what we're trying to do with Trident and what we're trying to offer investors. So that is really what gets us excited.
Well, I think, Yeah, I think it perhaps will appeal to the London investors. As I say, there's not many, I don't think, royalty companies on the London markets. There was another thing I wanted to ask you, seeing as you are from North America, and with me and Kenny having our sort of main interest, I suppose, in mining exploration. North America, particularly Canada, is obviously is where a lot of that is at. What's your feel at the moment? I'm trying to think how to word this. How are you feeling about the mining and exploration space? Are you excited? Are you bullish? Are we entering a new, long, overdue upcycle in the mining space, or just from your experience in the years you've been working, what you've seen, maybe you've seen a cycle before. How do you feel right now?
Yeah, I mean, there's a lot of excitement around gold, and I'm probably not as big a gold bug as a lot of people out there. But what I do really like seeing is obviously there's capital now flowing into the sector, and that does ripple through into the other commodities as well. So I think it's hard to try to call when the next upswing in a cycle is going to occur, but I think fair to say you're seeing more activity than you have in sort of the last 4 or 5 years. So the rumblings are right. I suppose we'll wait to see if that comes to fruition. But I mean, as it sort of boils back down to our business, it does come down to acquiring royalties over defensive assets. So something like bullion knobbing, where you see an operator putting tens of millions into the operation. Yeah, that sort of tells you that this thing can weather the cycles. And that's of critical importance from our perspective. So we look at it probably in a slightly different tack relative to the sort of equity markets.
Okay.
Yep.
All right.
Yeah. So looking forward then, Adam, just going back to Trident. So the market cap is about 24 million quid at the moment, I think, just in today's figures. Yep, that's correct.
Yep,
I 24 million. Right. Yep, you guys have got about I checked this the other day, about £10 million worth of cash. Is that correct?
Oh, pounds, yeah. Yes, that sounds about right.
Okay, so obviously you've got a nice wee war chest there for further royalty deals. So what's the landscape looking like in the next, sort of 6 to 12 months, for any potential investor that's wanting to get involved with Trident? How active are you guys going to be? You said earlier on you had 15 NDAs currently circulating. So I imagine you guys are busy assessing lots of projects.
Yeah, that's right. I mean, we're very busy assessing projects. One of these days, it'd be nice to squeeze in a good night's sleep, but I don't see that in my future for a while. But no, we're progressing some transactions and are sure to announce some in the nearest term. Really, though, I think this is, you probably hear this a lot, but I think this is sort of the exciting time to get involved in the company, because a lot of the things that royalty companies can do is, as they build critical mass, they start getting valued better. At the moment, we're not valued much above what our cash holdings had been had we just not done the deals. So, but you start to build critical mass, and then some important steps are sort of still to come. One of those is getting leverage against the portfolio. So, royalty companies have a much easier time getting leverage and a much lower cost of capital, because they are a sort of risk mitigated cash flow source of mining commodity exposure relative to a miner who's got a single project and is looking to get debt against it. Royalty portfolio is much more straightforward for lenders. So as we deploy the capital we've got on the balance sheet at the moment, we're in tandem, and we've got a debt mandate signed with Tribeca for 10 million, but it is a non-binding mandate at this stage. But it's continued to progress those discussions such that you unlock the debt to not only give your shareholders leveraged returns, but continue to build that critical mass without sort of continually tapping into the equity markets and diluting shareholders, because none of us want to do that. We want to build this thing in a smart way that maximizes our equity value. So yeah, I mean, getting leverage is probably sort of a nearish term target for us with regards to deploying this capital in such a way that it facilitates getting leverage, and then the leverage begets building more critical mass, which ultimately then begets being able to pay a dividend, and that is the fundamental ultimate goal, is to build a portfolio that has enough cash flow that it can be self-sustaining, in the sense that it's throwing off enough cash that you can get a revolver and and continue to acquire new royalties and replace royalties that sort of wind down, but doing so while also paying a meaningful dividend. You look at the precious guys in the TSX, and the yield is very, very low. But because the market's sort of comfortable with that business model, I think we take the tack that, look, we'd probably stand out pretty significantly if we let a fair chunk of our cash flow through in dividends, and that's ultimately what we want to do.
Good stuff. All right, Mark, I'm going to pass over to you to give Adam the 60-second challenge. You're better at explaining it than me.
Yeah, the 60-second challenge, Adam. Yeah, if you're up for it. So what we do, seeing as you are a CEO, we would ask you, we'd give you 60 seconds. I'll count you down from 3, 2, 1. And you have 60 seconds in which to do a pitch of the company as to why investors should consider investing in Trident Royalties. So, are you up for the challenge, first of all?
Sure, why not?
Okay. So, if you keep an eye on the nearest second hand in your area, when we get to about 50 seconds, I might give you a warning. It depends how I feel you are in the flow of things. But I'll count you down in 3, 2, 1. Off you go.
Sure. Well, hopefully I've touched on quite a bit of it already, but I think, if you're an investor sort of sitting on the outside looking in at what Trident's done, you can see that we've got a strong balance sheet with cash to deploy. You can pick over our existing deals, and I'm happy to field any inbound questions any investor may have. But you can pick them over, and I think you can back into what kind of returns we're targeting and what kind of returns we're getting on these initial royalties. What kind of cash flow we're going to be generating, and we'll be hopefully putting out more info to the market as we continue to build a portfolio in that regard. But I suppose the real crux of it is you can see the strategy we're executing on. Hopefully you can see that we are starting to execute on that strategy, and we're doing it in a smart, accretive way for equity. We've still got more capital to deploy on that regard. And as I mentioned, with regards to getting leverage and ultimately paying dividends, some really exciting sort of catalyst type things to come. So now is probably the time to get involved, because in 3-4 years time, hopefully we're a dividend paying company and we're pretty boring and vanilla and we're just picking up the occasional royalty. Now is when we're out there, pumping out deals, building the portfolio and doing all these exciting things. So I don't know where I stand on time limit, but
minute 10. I'll let you have 10 seconds there, because I thought you were nearly done. Yeah.
That's the 60-second pitch.
Yeah. No, that's perfect. Good. Well done.
Yeah. Bill, it's been absolutely fantastic having you on, Adam. Like I say, it's good to have different sectors on, and like I said, royalties, we've never spoken to anyone before, and now we've had 2 in a couple of weeks. But it's a fascinating model, and it's something I think everybody should have a look at. And the fact that there's only 2 companies in the UK doing the royalty model, it certainly seems like a no-brainer to have a look at it. But I appreciate the time, and obviously I don't know what the time difference is in Denver. Is it about 7 hours, maybe 8 hours?
Yeah, it's 10 a.m. my time, so yeah, it's pretty reasonable.
Yeah, good stuff. Mark, have you got anything to finish off with?
No, except say thank you very much, and I'll hope to visit Denver one day. It's on one of my lists of places to go. I've never quite made it to Denver, but I'd love to go. It's a beautiful place, beautiful part of the world.
No, absolutely. Well, let me know if you ever get over here, and hopefully we can do this again once I've got some meaningful updates for you guys, and we'll see where we've gotten to.
It'd be great.
Yeah, it'd be great to get you back on. But thanks for your time anyway, Adam, and we'll speak to you soon.
Thank you, Adam.
Great, thanks, guys. Appreciate it.
Cheers. Bye-bye. Thank you for listening to another podcast from Market Musings with Fairbairn and Russell.